Okay, so what we're going to do today is spend a little bit of time talking about health savings accounts. Now, we've mentioned HSAs plenty of times in the past, and in fact, on exam one, you had a couple of questions related to it. So just like with the FSA chapter, this is it's gonna be a bit condensed, and we're really just going to kind of focus on the little granular details that we have yet to cover about HSAs. Okay. All right, so a brief overview, just a quick little reminder. That's all we're trying to do here, just to remind you guys of the basis of HSA. So these are coupled with a high deductible healthcare plan. That's a requirement. We'll talk about what constitutes a high deductible healthcare plan. The the funds or the contributions are pre-tax, similar to like an IRA account, not Roth IRA, but a standard IRA or 401k. And then the withdrawals here for medical expenses are not taxed whatsoever. Additionally, unlike FSAs that we just covered in the previous chapter, you keep these funds and they're allowed to accumulate some savings. So there's an investment, small, but an investment element to these as well. So these type of plans are a traditional tax deferred plan that pair very well with 401ks, 403bs, or 457bs, because if you utilize those in a pre-tax way, then it just kind of creates this nice little essentially savings nest egg that builds up and accumulates interest without any tax on that interest. So advantages here. So the tax saving opportunities, you already kind of mentioned that. There's a savings element to it, but on top of that, compared to FSAs, we get to keep these funds. So if you have $3,000 at the end of the year left to roll over, it does actually roll over with an FSA. Whereas if we talk about it rolls over with an HSA. Sorry, rolls over with an HSA. Whereas with an FSA, like I said, if you don't use it, you lose it. So that's just something that you would be missing out on. Now, again, just to reiterate, FSAs are not they're not bad. I mean, it may seem like on the surface when we compare these to the HSA, you're like, well, why would I even use an FSA? But there are a few reasons that we might see that utilized, and again, we covered that previously. All right, so and again, these funds do garner interest, and there's no tax on that interest. All right. Now, it's not all great, right? There are always some cons, relatively speaking, to any of these. So really, HSAs are a bit out of grasp for lower income employees. And if we're looking at U.S. health insurance or healthcare in general, you can't get an individual HSA, in any real way, shape, or form. You have to be employed to get this. So lower income employees, self-employed individuals, it really does kind of set them back, relatively speaking. Why is it not why is it not ideal for a lower income employee? Well, because it's going to be mated with a high deductible healthcare plan, and you still have to put money into the HSA. Traditionally speaking, not all employers will add to the HSA. Employers can contribute. For instance, Ball State contributes a little more than $500 every year to my HSA. Okay, then that's great. That's great, but not every employer does that, nor is it expected. Okay, so lower income individuals, if you're lower income, you might already be struggling with savings, putting a roof over your head, money on the table, or food on the table, money on the table too, I guess. You might be struggling just to make basic ends meet. So how can you put $2,000-$3,000 into the HSA each year when you're already kind of on this thin line when it comes to budgeting? Okay, so if you're at a disadvantaged financial position, HSAs are not necessarily great. Now, that being said, if you go on the exchanges and look for individual healthcare plans, even with subsidies, the plans there are not that great. And if you look at FSA offerings, it might not necessarily be good either. So this kind of first disadvantage here is true for really just a lot of health insurance or healthcare options. Okay, I guess outside of Medicaid, but Medicaid is specifically designed for lower income individuals and mostly single mothers and their children, but lower income individuals for sure. Okay, so taxpayers in lower brackets see fewer reductions, right? Because we know tax rate is marginal, so you make above a certain amount, that next dollar, not every dollar, but that next dollar is taxed a little bit higher. So if you're in a higher income bracket, making more than 160 or 240 or 350, right? So those are some of the brackets. If you're making more of that, you get more of a tax advantage because Going from one bracket to the next could mean that every dollar after that is taxed 6% more than the dollar prior to it. So you're kind of seeing a gain of 6%, which is not, not anything to really kind of ignore. Whereas if you're on the median or lower income, going from $40,000 to $80,000, where the next kind of bracket within there, it might just be a 2% or 1% difference. So it's more advantageous to higher income levels, but again, specifically, kind of in the mid to higher tier brackets, which would be around 160, 180, and on up. Anything below that, the advantages are pretty consistent. And that's roughly 95+% of people, 96 or 97% of people are going to be making less than 160 or so. These are individuals, not households. And household incomes are going to be a little bit higher, obviously. And then this could lead to adverse selection into other plans, right? There are lower income employees that don't really want to see it. But so younger, healthier people tend to value HSAs more. Thankfully, I'm in that category, but for the most part, an HSA is pretty valuable if you can even get enough money into your HSA to cover your deductible and a good portion of your co-insurance, then you're really in great shape, because if you don't need to use it, it's still savings for you. You still have it for medical expenses, and something we'll touch on just a little bit later, you can roll it over into a retirement account. So if you don't use it, you can roll it over. Okay, now once you hit 65, you have Medicare, and there are some stipulations there with HSAs. You can't really contribute to them in the same way or at all, but you still have it, and you can use it to pay for medical expenses tax-free. What's required? Well, it has to be offered by, for the most part, what we're looking at here is employee benefits, so it has to be offered by an employer. Now, what is a high deductible healthcare plan? So an HSA has to be paired with a high deductible healthcare plan. That means that the deductible, that's what we're talking about here in this first bullet point, the deductible has to be at least $1,350. Now, it's kind of peculiar to think of that as high deductible. It was 15 or 20 years ago, but $1,300 or $1,400 is quite frankly not a high deductible anymore. Healthcare costs themselves have increased quite a bit. The average knee surgery is going to run you 60 grand. So a deductible of $1,300, $1,400 here is not that bad. And, if we compare it to something like, personal auto policies, and you have a deductible of $500, but not everyone's driving a $60,000 or $70,000 car. So it's hard to say that this is high deductible, but it's all relative as long as you meet that. As kind of a benchmark, so the HSA plan that I utilize now, that I have now, has a $2,000 deductible. So there you go, per person. For the family, I think it's 4,000. It generally is just doubled, but I'm not 100% sure on that. So it has to be with a high deductible healthcare plan, right? Because if you had a traditional plan that had, let's say for some reason, a lower deductible, which is frankly going to be difficult to find, but let's say that you did, then it's just another retirement vehicle for you. And if you're wealthier and you can max out your 401k and an IRA, then you just have another $3,500, $3,600 you put into a tax advantage account. And we would argue that that might be a little not intentionally discriminatory, and there's nothing wrong with someone wanting to have a tax advantage account, but it's going to benefit higher income earners disproportionately, and lower income earners are going to be kind of left out of that. Now, how will we go about implementing this? So the employer, again, so this is really just kind of a copy and paste from the FSA slide on implementation. It's very much the same. Okay, the employees, you elect salary reductions in the upcoming year, and then you use those funds. Now, HSAs, we talked about ex ante or ex post funding. With an HSA, generally speaking, you're going to have a debit card that you'll run to pay for qualified medical expenses. So we could say it's technically ex post, right? Similar to an FSA, whereas FSA, that might not always be a case. You would just ask for reimbursement and show that you had a qualified medical expense. The difference here is that any funds remaining do roll over. So that's the kind of the primary difference here. Other features, you get traditional medical reimbursement. Now, contribution limits. This actually changes for 2021. It's $3,600 for an individual, So 2020 stays the same. 2021, it's 3,600 for an individual, and I believe 7,200 for a family. Okay, that's not quite set in stone, so it hasn't been codified just yet, but it's looking like 36 for sure, and then 72 for a family. But here, 2019 and also 2020 is what we're looking at: 35 per person, 7,000 per family. If you're above the age of 55, you can put a little more. We tend to see catch-up contributions be a very common thing, mostly because people, for whatever reason, don't adequately save for healthcare and also retirement. But that's kind of a, it's a dead horse at this point. We all know that. If you've been in my class, been paying attention, then that's nothing new to you. Okay, and then the contributions may be made by an individual through salary deductions, or employers can contribute as well. It's not, again, I want to reiterate, it's not that common for employers to contribute a substantial amount. Some do. So if you find yourself, on the job market and you have firm A, firm B with job offers, everything else is pretty consistent, but one, is going to match a good bit more to the HSA, then I mean that might be one of the deciding factors right there. Not only is it money that they're just giving you, okay, but it's pretty rare to see a good bit from the employer being contributed to an HSA. Okay. Now, distributions or disbursements, however you want to kind of look at this. So they're for qualified medical expenses that are part of your high deductible healthcare plan. It's very difficult and rare for people to try to skirt that. So if it's not covered in your plan, it's rare that you can use your HSA funds. But that's not always the same, because an HSA fund, the stipulations on those funds vary, but could be different than the mated or paired high deductible healthcare plan. Okay. So any other distributions are subject to a 20% tax penalty. Okay, so this really shouldn't be seen as a traditional savings account. Okay, it's for healthcare expenditures, or kind of a cushion in retirement. You can still use it for healthcare and retirement. You can't contribute if you have a Medicare plan, but those funds are still yours to use, and you can still use them for medical purposes to get to your Medicare, let's say deductible and through co-insurance. Or you can just roll it over to a retirement account, or you can let it sit in the account. Okay. Usually disbursement requirements by states don't require you to empty out your HSA, quickly relative to some other interest-bearing pre-tax accounts. Now, taxation, contributions are deductible, and this is actually regardless of itemization. So you get the standard deduction, and then also these are counted as deductible too. So that's a nice little shield as well. And most states do adhere to this, and this sticks with municipal taxation as well, similar to FSAs. It can't be combined with medical expense reimbursement. So with a standard health insurance plan, what you should be doing is saving those medical payments or charges for qualified medical expenses, and then using that to itemize and then reduce your tax burden. You can't do that if you are also paying for them with a tax advantage account like an HSA. Why? Because you're essentially double dipping. You're paying for it pre-tax with HSA funds, and then you're going back and saying, now reduce my tax burden even more, based on these contributions, right? So if you have $1,000 in your HSA, that's $1,000 that you don't have to pay taxes on. So whatever your appropriate rate may be. Then you have $1,000 claim, and then you pay you pay out the claim, and then you're going to try to say, oh, my tax burden should be another $1,000. So you're doubling up on the quote unquote tax advantage. So you can't do that, right? That creates huge moral hazard issues, and would be just kind of asinine to let that flow through, right? So tax accountants are not going to let that fly. The IRS is not going to let that fly. And then employer contributions are deductible, and they're not subject to Social Security unemployment taxes. So kind of with the FSA payments as well that we went through. Okay. All right. So let's round this out with a couple of frequently asked questions that you may have yourself, or you may hear if you're an advisor, you're trying to help someone in the future. So the first question is, well, why don't I just use a standard savings account? Like what am I getting out of this HSA? Now you're probably kind of seeing this already and knowing the answer, but just to clarify, because you're going to be advising people that may not have had this class, or may not have an undergrad in finance or risk management or anything like that. So while you're limited on distributions, if you just want to have a savings account, so if your employer offers an HSA and you just want to have a savings account separate to that for your medical expenses, that savings account is going to be after tax, right? So there, if that's why you want a savings account and you're foregoing an HSA, you're making a bad financial decision there, and there's really nothing to be gained from that. Whereas if we look at buying a new car, that's a bad financial decision. But hey, a new car smells nice, they look nice, they're fun, so you can kind of understand that expense. But here you're just leaving money on the table. So this kind of leads us to the next point. We've covered this in previous chapters as well, but let's reiterate. What do we mean when we say triple tax advantage? So we could really get into the details here and the nitty gritty and say, all right, but is it really tax advantage, in three different ways? For all intents and purposes, yes, for the most part. So the way we can look at that in general is the first tax advantage is that we're not taxed on these contributions. I put $1,000 in a year. I'm not taxed on that $1,000. Any distributions are not taxed for medical expenses. And then any interest that is accumulated on that $1,000 or whatever it may be in the account is not taxed. And again, that's similar to like a traditional 401k plan. So those are kind of the three tax advantages. You could argue that if you roll it over into a 401k or IRA, it's also not taxed then. But if you withdraw those funds, then obviously you'll be taxed. And rollovers into Roths, obviously you're going to have to pay the tax ex ante or prior to rolling over into that Roth account. Okay, and that's it for health savings accounts. Again, we've already kind of discussed most of this, but we get a little more, as I said earlier, granular detail, kind of getting a little bit closer with that microscope on these. So we have this chapter to kind of cover that and provide a little more information on HSAs. So my takeaway of this, or what I want you to get from this, is traditionally speaking, for most people, HSAs, especially the employers contributing and the deductible is not too high with a paired plan, HSAs tend to be a really good deal. They tend to be a really good deal for most people. And I tend to suggest, to at least seriously consider utilizing HSA. But keep in mind, what's good. There's never a one size fits all. Okay, so we always want to be careful. We always want to be kind of prudent in our advice and say we need to know for sure if this is good for everyone. And the thing is, it's not always good for everyone. It's better for most people, but there are some that aren't able to see the advantages of HSAs.